Okay, so as always, we're gonna label this so that we have, when we come back, we can easily locate with a heading. Analyzing our factors using alpha lens. Okay, the first thing we need to do is to actually get pricing. Okay, get the prices. But before we do that, we want to make sure that we're not getting the prices for all the stocks, because the universe here is actually a lot smaller. So how do I know? So let's just take the and store all of the so-called assets or the tickers that is being mentioned in the pipeline. So we're going to take result. We're going to take the index. Remember, the full index here refers to the date as well as the ticker. So we're going to refer to the index, but because this is multi-index, we're going to refer to just the second level. Well, in this case, 1, because Python start counting from 0. So we want to store all of the unique tickers into assets. Okay, and let's look at the length of assets. This 1620. So that's the point. That's the reason why we don't want to pull out all 8,000 stocks or tickers, because we don't need all 8,000 of them. It's just going to waste your memory and slow down computation. So let's just store our pricing data into the variable called pricing, and just get pricing. And the first parameter put in is assets. That's the 1620 assets that we want. We're gonna get the start date data, but we're gonna start from 2013 or 1, December or 1, but we're gonna end a little bit later. Reason being, we want to give the alpha lens a bit of data to see if there's any predictive power going forward or not, and we're gonna just pull out the opening price rather than the closing price, because we're likely gonna use the open price to actually close the so-called position itself. Okay, so the next thing we want to do is that we're gonna break this into 2 quantiles, meaning split it into half, the top and versus the bottom quantile. It would be better if we can actually split it into more so-called percentile, maybe 10 so-called percentiles. But for now, until the alpha lens has been so-called being pushed to the newer version, right now we can only conduct on 2 quantiles. So next thing to do is import alpha lens. Okay. And we're gonna run, we're gonna run alpha lens, and we're gonna create the tier sheet and create a factor tier sheet. And the factor that we're gonna analyze is result sentiment. Okay, which is that one there. Okay, based on this one here. Okay, and the prices is based on pricing that we extract from get pricing, and we want to look at 2 quantiles. And finally, we want to have a look forward period of 1, 5, 10. If you want to, we can look at 20 days look forward as well and just run this. Okay, we have an error message. Periods. Okay, this one might take a wee while to run. Okay, so just have to be a little bit patient as we run this. Typically, the so-called table comes out first, as it is right now. Okay, if you look at the returns analysis, I'm not too worried about the quantiles analysis. I'm more interested in the returns analysis. This is 1-day look ahead, 5-day look ahead, 10 days, and 20 days look ahead. The annualized alpha for 1-day look ahead is the largest amongst the 4 here. It's 5.4% versus 1.9, 1.9, and 1.3. which makes sense because sentiment tends to be short-term in nature, not long in nature. So that's the one thing that you want to look at. Of course, there are other things that you need to consider, which is the standard deviation, whether that number is significantly larger than 0 or not. The good thing is, if you look at beta, the 1, 5, 10, and 20 days are all very, very small. It varies from minus 0.02 to minus 0.03. So it's basically 0 really. Of course, you also want to look at the standard deviation of the beta. Okay, let's look at the information analysis itself. Again, this time we're looking at the 1, 5, 10, and 20 days. Now, if you look at the information coefficient for the mean of 1 day is very small. 5 is also very small. What we want to look at more importantly is the p-value. Of course, you can look at t-statistics, but I'll just use the p-value. It's fast, and I don't have to spend time calculating or look up a table. So if you look at the p-value, let's just say my p-value where I have a decision point is 5%, you will see that the 1 day is significant, 5 days is not significant, the 10 and 20 days are all very significant. In fact, the 20 days is very significant, but that's not the point. Remember, the use of p-value is if it's less than 5%, then it's significant. So the 1, 10, and 20 days are all equally significant. The good part about these numbers is that I see the skew is to the positive side. So that's really always plus side. The kurtosis is okay. The annualized information ratio is really, really healthy. So if we look at the turnover, okay, it's all right. It's 55% turnover. Okay, so this is what you want to look at. Remember, we are looking at the 1 day, 5 day, 10 days, and 20 days. And we're looking at the 2 quantiles. Do remember that we split them into half, the 1 day and also the 20-day quantile. If you look at this, the 1 quantile mean is quite a lot under 0. The 1 second quantile, which is the one that you want to go long on, this is the one that you want to go short on, this is the one you're going to go long on, is significantly above 0, which is always a bonus. But these seems to be very, well, insignificantly different from 0. So this is the 5, the 10, and the 20 days. And if you look at this, the 1 day is healthy. Over the course of 1 year period, it generated 5% return. Doesn't sound like much, but it's actually, later on, we obviously need to consider the risk factor or the so-called standard deviation that goes with this. We want to look at the Sharpe ratio. Looking at the 1 and 2, the color here, this is 1. Okay, so it's going, this is a beautiful chart. What you really want to see is that they're going further and further away from each other. This is the 5 day. Remember, this is a long short portfolio. You long the upper quantile, you short the lower quantile. This is not so healthy. The 5 days is not really that. The cumulative return is not really, it doesn't go up steadily. It fluctuates too much to be of use to us. 10 day is okay. It's not too bad, but you notice that the actual return is only 1.2, whereby the 1 day is 5% in comparison. Although, and let's look at the 20 day. The 20 day is also not that significant. It's about 1%. It's really not that exciting at all. Other things that you can see here is the mean return of the top minus bottom. There are some periods whereby it dipped below 0, but generally it's mostly above. The 5 day doesn't move too far away from the 0. The 10 day too, as well as the 20 day. What you really want is that this orange line continuously and consistently stay above 0. That's really what you actually want to see here. These are in basis point, by the way. Okay, looking at the information coefficient, generally above 0. for the this is the 1 day, 1 period. The 5 period is fluctuates around 0, so it's not really that exciting. The 10 and also 20 is also fluctuate around 0 really. The distribution plot as well as the QQ plot check. Okay. Not much you can say about here except that there's actually some positive skewness here. These 2 points here makes this, as long as it stay along this red line, is normal, but these two makes it a little bit not so normal or skewed to the positive side. Okay, looking at the monthly mean return, so generally green for the 1 day, 5 days also green, 10 day, on 20 day they're all green. Well, that's pretty good. Oh, there is some negative here that's slightly orange. Oh, in fact there are some negative here. The font's just too small for me to read. Okay, so these are the turnover. So you're looking at almost 50% turnover. Well, on average it's about 60%. So this is the one thing that you probably have to consider, is that how much it does turn over. It seems to be quite a lot. This may have an impact on the profitability of this strategy. If the turnover is too high, it starts chewing into the so-called the profit that you generate, and this kind of strategies is probably not going to be suitable for retail investors with 100,000 to invest. You probably need somewhere around, looking at this, maybe 10, maybe 100 million and above, easily, definitely over $1 million to make this profitable, whereby you might need a prime broker rather than the retail broker, which the fees will actually eat up the amount of turnover that you make. Okay, so the factor rank autocorrelation is generally mean of 0.12 is not very high, it's actually quite low. So this is really alpha lens. It allows you to actually quickly see whether there is any signal in here. From here you can actually do a very quick judgment, just looking at the p-value itself. Okay, this is not too bad, but this is the one thing that's quite troubling because the IC mean is quite low, although the annualized alpha is quite high. I think based on this, it means that the standard deviation is rather low for this strategy. So having done all that, what we're gonna do is to move on to actually conduct back testing in the IDE and just basically test this strategy and see how it actually really perform in the so-called real world. Okay.